My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Sometimes the glass is half full. Sometimes it's half empty. But I'm going to introduce you to a whole new category tonight, a third category. Sometimes the glass itself shrinks, making a half-full vessel look like it's overflowing. And you know what? This is where we are right now. In this, after today's session, Dow closed flat. S&P inched up 0.16%, Nasdaq advanced 0.26%. I'm going to give you some examples. Let's start with the old thing that we all know, which is the half-full, half-empty. Walt Disney. This morning, Disney launched its new streaming service, Disney+. Almost immediately, the site was overwhelmed with traffic and started having outages, even though management had just assured us that the technology was solid on the conference call last week. Remember, we were told they tested the system in the Netherlands, which must be like a new worldwide Peoria, although the pilot program reminded me a lot more of Amsterdam from The Wire when I first heard it. In a glass half-empty situation, well, we decide that Disney must be run by a bunch of technological lightweights who botched the rollout of a promising new service. However, the glass half-full people think very differently. To them, it's a high-quality problem. Sure, the site crashed, but that's probably because there was so much demand, so much traffic. Disney vetted this platform for millions of people, and apparently even that wasn't enough. It's not hard to believe their streaming service has so much great content that it must have caused a stampede of subscribers. Now, in reality, I think both of these camps are right. Well, Disney obviously dropped the ball. They also feel like victims of their own success. This isn't a question of who's right. What matters is which contingent is calling the shots here. Who's got the most firepower? How many divisions do they have? And given that the stock rallied nearly $2 today, it's clear that the glass half full folks have the most divisions. Disney's situation is normal, but now I'm going to introduce this. There's always a half full, half empty camp. Well, what does it look like when you add this third camp in? All right, get this. We're seeing this more complicated dynamic when it comes to the trade war. Today, President Trump said we would be close, very close to a deal with China when he spoke at the Economic Club in New York. The president explained that the Chinese are, quote, dying to make a deal. We're close. But then Trump seemed to torpedo his own positives by saying he'll raise tariffs substantially if there's no deal. Personally, I thought the latter statement was more important when you consider how high this market is. I doubt it can absorb much higher tariffs. But if the Chinese really are eager to make a deal, well, that would give the averages a major boost. Now, the glass half-empty contingent only hears that the December tariff hikes might be in play and the hardliners are ready to jack up the pain. It's almost as though the trade hawks in the White House believe that doves like Larry Kudlow, the president's chief economic advisor, and Steve Mnuchin, Treasury Secretary, were undermining the president's case when they said there could be a deal last week. The glass half full crowd focuses on the first part of the statement. President Trump's not ruling out a deal. He said we're close, so they see no reason to get discouraged. But then there's this third category. It's the glass totally full camp. They saw Larry Kudlow standing at the president's side, and they say, wow, the president respects Larry to the point of repeatedly referring to him at this luncheon, and it makes them think a deal might be imminent. When Larry spoke to CNBC later in the afternoon, he talked about how there could be some real agreement going on, especially with the Chinese government allowing our financial firms to own entities within China. He made it sound like just a matter of time before we get a deal. The market rallied when Trump said we're close to a deal. When it went back down, well, when we heard that the tariffs might be boosted, it looked like it was going to go really, really low. But then it bounced again once the glass is totally full crowd started chiming in. I think the optimism of this third group is almost unhinged. But clearly, plenty of money managers believe that this is not nearly as good as this. Let me give you another example. Rockwell Automation. Just a second. This is a really important card that shows you exactly what kind of community crosstalk show we got going here. Automation, Rockwell Automation. Here's a metal bending company, one of the best there is. Rockwell is deeply cyclical, meaning its earnings are hostage to the strength or weakness of the economy, the slings and arrows. We've been told over and over again that cyclicals are on their last legs, right? Because they're going to report weaker numbers than last year thanks to the softness in the industrial economy. Well, apparently Rockwell Automation missed the memo. The company just reported a spectacular quarter, 1.4% organic growth, including real strength in some key end markets, oil and gas, mining, life sciences, cybersecurity, autos, food and beverage. And that's why the stock pulled at $18, 10%. Now let's mull this one over. A glass half empty investor thinks, are you kidding me? When is 1.4% growth any good? That's anemic. It's pathetic. Rockwell's growing more slowly than the American gross domestic product. How's that good? Oh, glass half full guy says, that's not so bad for cyclical. In fact, it's a lot better than I feared. But remember, not as bad as feared. But how about the delusional glass is totally full guy? Okay. He looks at this and he goes, holy cow. Rockwell's much better than I thought. I didn't know it had life sciences or cybersecurity or food and beverage exposure. Maybe it's less cyclical than we thought. Heck, let's buy some stock. Next, this morning, Tyson Foods. Ugly earnings. Bad miss. Everything. Processed food, chicken, beef. Seemed weaker than expected. The only thing that wasn't weaker than expected, I kept waiting to see those pea-based chicken tenders that they sent me. They weren't included. The stock looked like it would be down 5% as investors seemed to tire of the company's inconsistent track record. Oh, that's a half-empty attitude, right? Then once the conference call got going, management started telling a more encouraging story, giving you a sense that this too shall pass. Stock ended up recovering all its losses to the point where it was flat. Next thing you know, despite the severe shortfall, Tyson's saying he gets some high single-digit growth going in the future. Now, I have to tell you, as recently as the beginning of September, this stock would have been poleaxed on this kind of quarter. Even the glass half-full contingent would have had a hard time trusting these guys after such a serious shortfall. But this market is now dominated by the tiny cup crowd, the people who think the glass is really full because they have the wrong frame of reference. So, the same news ultimately sent Tyson stock surging up 7.4%. A full glass. What else? Facebook launches Facebook Pay. Who the heck trusts Facebook these days? A month ago, the stock would have been pummeled on this news because the glass half-empty contingent was in control. Today, it rallied $5. Glass full. Finally, AbbVie's taking down $30 billion in debt to acquire the hapless Allergan. Is that bad news? I mean, well, it turns out there's demand for $44 billion in debt, and the stock ends up rallying. I mean, it makes me feel like, you know what? The glass is full and then some. The bottom line. My mom hates it when I talk about a mouthful. She hasn't been with us for 34 years, but I still remember it. The bottom line is that I can go on and on with these examples. So how long can this glass totally... Oh, my God. We'll edit that out in post-production. Like this show is post-production. I mean, look at this. Look what we have here. I mean, aren't these great? Okay. I think that as long as the interest rates stay low, I'm a serious guy. This sense of optimism can sustain itself until we get some bad news on the China front. Of course, if there's a major trade deal, the glass is full crew, that will turn out to be right. Otherwise, it's going to be too bullish unless some fresh money comes in from somewhere to take us higher, regardless. Whose brilliant idea was this? Jim in New York. Jim,
hey. Listen, Jim, I'm calling about an investment in my kids' trust accounts.
Okay.
And I have a long view investor mentality when it comes to that.
Okay.
So we're sitting on 80% short-term gains. Short-term on XPO Logistics at $85. That's still $30 below its 13-month high. And I don't know what it is, whether it's trade news expectations, fundamentals, but these accounts belong to youngsters still years from college, and an unrealized gain makes
well, look, I want you to cut it in half. Now, why? I think Brad Jacobs is terrific. I like XPO, but it was rated down. Shorts hammered this thing and hammered this thing and hammered this thing. Now, the shorts will say, well, Jim, that's because it belonged to me there. But I think Brad is a good man. The stock is up a lot, but now it sells at 22 times earnings. And that's too expensive versus the rest of the group. Charles in Maryland. Charles.
Mr. Cramer, how are you today, sir? Hopefully,
Charles, this is one banner day. It started at 3:15. It just keeps rolling. What's up?
Oh, that's not bad. That's not bad. Mine started at 4:45. So
early bird gets the worm, Chief.
That's right. I'm trying to get one myself.
All
Listen,
right.
I wanted to ask you about Iron Mountain, and I was looking at the dividend on that. Dividend yield 7.5%. I thought that was a cautionary tale, but it seems that they're doing well in digitalization of documentation and storage. So I wanted your opinion on them. It seemed like they're floundering, but you give me your ideas.
Look, Charles, I'm with you. I mean, I wish they would come on. I have liked this stock because of the yield, but the stock doesn't go up. And in the end, I prefer growth and yield, not just yield. But you and I are in the same mind. It does seem like a bit of a red flag. We've got to find out where's my red flag. Oh, well, let's just dip everything in these, okay? I think the optimism can last, but I think it may be a little too bullish, which therefore makes me throw the red flag. On Mad Money Tonight, with news that Facebook is introducing a payments feature, how is PayPal positioning itself? I've got the CFO. Then a CNBC investigator reports some shares of the reeling, that one is 2 E's, last week. Tonight, the CEO responds to reporting that fake items are being sold on the site. And Micron stock has been volatile over the past year as drama with DRAMs impacts the stock. I'm going to sit down with the CEO of this incredibly wild trader that I know so many of you care a great deal about. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.